Alrighty, guys, welcome to the Trading Academy day. Man, I don't even know what day it is, and I'm so sorry that I did not upload a video yesterday, man. I had to do some stuff. I didn't pre-record these videos, so I'm actually making the video right now to upload. But yeah, welcome to day 39, where we're going to be going over the unicorn model. Now, real quick, I was just going to upload like the other recording that I already did on the unicorn model because I explained it pretty well in those videos, but I have a whole playlist on my channel. If you guys like this unicorn model, it's like the most simplest, best like beginner friendly model out there. Okay, so if you guys like the unicorn model after this video, I have a whole playlist. It's called Get Funded in 2024. It's just all about the unicorn model, breaking down the concepts needed for it. So if you guys are interested in that, you guys can find that on my channel. It's just a whole playlist dedicated to the unicorn model. It's one of my favorite models as well because it's just very straightforward, very simple, very easy to catch when you know you're drawing liquidity. And again, that's like the basis for everything is drawing liquidity. But yeah, let's get into it. So the unicorn model is very, very simple. Okay. So imagine you have a breaker and a fair value gap combo like this. And I'll show you guys some examples, but just imagine you have, your low, your higher high, then the break of the low, and then you have that last down close candle. That's your bearish breaker. And then vice versa for the bullish scenario, right? You go low, you break the high, and then you have your bullish breaker, right? So you have the short-term high, the lower low, the higher high, break above the high, so the last up close candle there. And then you have your bullish breaker and fair value gap, okay? So the unicorn is going to be FVG plus breaker block combo, okay? That's what a unicorn is. That's all it is, right? It's just a fair value gap plus a breaker, okay? Overlapping with each other. Now, sometimes you'll see that the unicorns, like, you don't need a tap of the breaker all the time. Sometimes you'll get it, sometimes you won't. I personally like always entering on the fair value gap because the fair value gap is just, in my opinion, better. Sometimes, like I said, you won't get the tap of the breaker, but you will get the tap of the fair value gap. I'm going to go ahead and show you guys some example so that way you guys can see what it actually looks like, because anybody could draw this and be like, oh yeah, it's really simple, right? So let me go ahead and show you guys some examples. So let's go here. I'll show you guys some quick examples here. It's a very, very simple model to follow, to be honest. And there's one actually today here. So remember what I said about breakers. If you guys haven't watched the breaker block video, go back in the academy, watch the breaker block video, and come back to this video, okay? So just on the 15-minute time frame right here, right? We have let me go ahead and mark it out here. We have a breaker block right here. Remember what I said? Bearish breaker block is the last down close candle, right? Last down close candle of the swing low or by the swing low. It doesn't need to be the swing low. It can be by the swing low. So this is the last down close candle of that swing low that took the high, right? So you have a sweep of the high here, and then it goes higher, right? So this is the last down close candle of this swing low that sent price higher. And then what? We get a break, right? So we have our low, we have our high, and then we get the break of this swing low. And then what's next to it? This down close candle. This is the last one, right? You drag that out. That is going to be your breaker block. And now all we have to do is just pair it with the fair value gap. So here is our 15-minute fair value gap, right? And now we know we don't have any bodies closing above the fair value gap, okay? We don't have any bodies closing above the fair value gap. Now, if I pull out the ES chart, you guys will see that there was an SMT in this, okay? So that makes it even better. We're having an SMT in a key level, which is this unicorn. So this makes it even more high probable, right? It makes it more high probability, sorry. You have an SMT here, equal highs, right, on ES. And then you have the higher high on NQ in this fair value gap, refuses to close a body above this fair value gap, taps the upper level of the breaker, and then it closes below the fair value gap. And now you can enter short here, place your stop above this high. And usually where I like placing my stops on these unicorns is it'll look something like this, right? I'll usually place a limit. If I want to take a unicorn, I'll usually place a limit at the fair value gap, and then I'll put my stop above the candle's high that form the fair value gap. So it would look something like this, okay? So limit at the fair value gap tap, right? This is like a perfect unicorn because the fair value gap and the breaker block are overlapping like amazingly. Like this is really good. And then you place your stop loss above this candle's high. It came very close to tapping it, but it didn't. Sometimes if you want even more of a wiggle room, you'll go to the next candle and you'll put it above this high as well. but I usually like keeping my stops pretty tight like this, about almost a 10-point stop, 9.75 point stop, and then you just target your drawn liquidity, right? What did price look like? Like, where did price look like it wanted to go here? Okay, let me take this off because I know it can be distracting sometimes. But where did price look like it wanted to go before we tapped into the unicorn? Right, it wanted to go down to this low, right? We had nice displacement. It fell very short from it. We retraced back up into this unicorn, right? Breaker, fair value gap combo, refuses to close the body above it. Remember, it could wick. It's perfectly fine. But this is where I would set a limit in my stop above this candle's high that formed the fair value gap. Okay. And then we would take it to our drawn liquidity. And this took a long time to play out. But as you guys could see, it ended up working out there. Okay. Very, very nice unicorn here on the 15-minute. And big tip real quick. I love unicorns on the 5-minute and 15-minute. That's really, like, if I wanted to play unicorns, that's where I would play them, is on the 5-minute and 15-minute time frame. Okay. So let me go ahead and find you guys an example of a bullish one. Okay, so here is a good bullish example of a unicorn, right? So we have our low, right? We have our low right here, high, and then we break through the low, and then we push all the way back up and we close above this high right here, okay? So this last up close candle before we came and swept all these lows right here, doesn't need to take this low. It's just the last low that sent price to go higher, right? This up close candle here, when we close bodies above it, this breaker becomes valid, okay? Now, here when you mark out this breaker, right, it kind of overlaps with the fair value gap, but like the other example I showed you guys, the bearish one, that one was a perfect one because they overlapped like perfectly with each other. So when you get this fair value gap and it's like barely overlapping with the breaker block, that's perfectly fine. Sometimes you'll have a breaker block like all the way up here and the fair value gap all the way down there. As long as they overlap a little bit, you're good, right? And you have to have an understanding of bullish, of drawn liquidity. I was going to say bullish order flow as well, but drawn liquidity is even more important, right? So we have this high right here. So it seems like it's going to go higher. As long as you have an understanding of where price is going to go, because your drawn liquidity is correct, and you know where price is reaching to, and it failed to reach there in this example, right? It was reaching for this high, but it failed to. Now we come back down, right? And then even like discount, if you mark this out, came into discount, tapped OTE. And then we started pushing up. And towards the end of the day, this took a very long time to play out. But as you guys could see, it ended up sweeping the high right there. But this was a valid bullish unicorn, okay? It's basically just a breaker block combo, right? Breaker block combo, breaker block, and fair value gap combo. That's all a unicorn is. It's nothing crazy. But in the next model that I'm going to show you guys tomorrow, it's like these unicorns are going to be really, really nasty if you can hit them with the next model that I'm going to show you guys tomorrow. But this in itself is a perfect, beautiful, simple, very beginner friendly model that you guys can take into the markets and use it to make money in the markets, in live markets. Okay. This is a really, really simple model. This is one of the models that I feel like I popularized a lot on social media, but yeah, hope you guys enjoyed this video on the unicorn model. And tomorrow we will be talking about the candle range theory. That's a more advanced model, but unicorns come after that model. So it's really, really nice to learn that model. Okay. So if you guys are just one more tip, if you guys are going to trade just the unicorn, use them on the 5-minute, 3-minute, and 15-minute only. That's, in my opinion, the best time frames to use unicorns on. Okay. They work beautifully. Trust me. It has a very, very high win rate, and it's again, it's a really nice model. So I hope you guys enjoyed the video. Please comment, please subscribe, please like the video if you guys enjoyed it, and I will catch you guys in tomorrow's video. Peace out.